Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about PBF Energy INC quarterly report. PBF Energy Inc. offers a diverse range of businesses and services, including refining, producing petroleum products such as gasoline, diesel fuel, jet fuel, lubricants, petrochemicals, and asphalt logistics, supplying petroleum products to various regions in the U.S., Canada, Mexico, and internationally terminaling services, plus rail transportation, plus truck transportation, plus marine terminaling services, pipeline transportation, and storage services. The company operates through two main segments: refining and logistics, serving multiple regions across North America and internationally. The significant increase in PBF Energy Inc.'s stock price over the past year can be attributed to several key factors. Improved financial results, driven by a turnaround in the second and third quarters of 2025, have been a major contributor. The company's net income has increased dramatically, with Q3 2025 reporting a net income of $171.7 million compared to a loss of $289.1 million in Q3 2024. Additionally, PBF Energy has consistently declared a quarterly dividend and demonstrated a commitment to returning capital to stockholders through dividends and share buybacks. The company's strategic initiatives, such as the Refining Business Improvement (RBI) initiative and asset sales, have also contributed to its financial recovery and flexibility. Furthermore, analyst upgrades and favorable market outlooks have further boosted investor confidence in PBF Energy Inc.'s stock price. With a positive long-term outlook expected by management, driven by global refining supply and product demand remaining tightly balanced, the company's stock is poised for continued growth. The primary drivers of revenue growth or decline can be summarized as follows. Revenue decline is primarily driven by a decrease in refining margins, lower hydrocarbon commodity prices, and unfavorable movements in crude oil differentials. Additionally, lower throughput volumes, the Martinez refinery fire, and temporary shutdowns have also contributed to revenue decline. On the other hand, revenue growth is driven by gains on sale of assets, favorable movements in crack spreads, higher throughput volumes, and barrels sold at East Coast and Chalmette refineries. Net income and profit margins. A shift in fortune, the financial performance of the company has undergone a significant transformation from Q3 2024 to Q3 2025. Net income, which was -$289.1 million in Q3 2024, skyrocketed to $171.7 million in Q3 2025, marking an impressive increase of $460.8 million year-over-year. However, this growth is not reflected in the profit margins. The gross refining margin decreased from $2,069 million in Q4 2024 to $1,752.9 million in Q3 2025, while the consolidated gross margin plummeted from -63.7% in Q3 2024 to -439%. The reason behind this discrepancy lies in special items such as LCM inventory adjustments and expenses associated with the Martinez refinery fire. These one-time costs have significantly impacted the company's profit margins, masking the underlying growth in net income. The company's operating cash flow has been inconsistent over the past 2 years. In 2024, it generated a positive operating cash flow of $373.1 million. However, in 2025, this trend reversed with a negative operating cash flow of -$444.6 million. This fluctuation indicates that the company is still working to stabilize its financial performance and generate consistent positive cash flows. The company's debt level has seen a substantial increase, rising from $1,457.3 million to $2,394.3 million over the given period. This significant rise in long-term debt is accompanied by a notable surge in interest expenses. The net interest expense has increased from -$21.4 million to -$50.3 million, while the total interest expense has jumped from $93.3 million to $150.1 million. These changes indicate a substantial shift in the company's financial landscape, with both debt levels and interest expenses experiencing significant growth. Management's outlook on company strategy. The company is focused on achieving cost savings and operational efficiencies through the Refining Business Improvement (RBI) initiative, which aims to reduce expenses and improve productivity. Additionally, management expects to invest in facility improvements and refinery maintenance, allocating $750–$775 million for these purposes in 2025. To mitigate risks associated with commodity price volatility, the company may use non-trading derivative instruments to manage exposure to natural gas prices. Management is also confident that the company's cash flows will be sufficient to meet its capital expenditures, working capital needs, and other obligations over the next 12 months. The company has a strong liquidity position, with $2.1 billion of operational liquidity as of September 30, 2025. However, management notes that there are no assurances that the company will be able to meet debt incurrence covenants in the future. Overall, management's strategy focuses on cost reduction, investment in facilities and maintenance, and risk management through derivative instruments. The company is committed to complying with environmental and safety regulations, which may require ongoing capital investments and changes in operating procedures. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In recent years, it has paid out significant amounts in dividends, with $95.8 million in 2025 and $88.3 million in 2024. Additionally, the company has also been actively buying back shares, spending $7.8 million in 2025 and a total of $300.1 million over the first 9 months of 2024. Concerns about inventory buildup or supply chain disruption exist. The company's financial summary reveals concerns about inventory buildup and supply chain disruption. Inventory levels decreased by $147.4 million, indicating a possible accumulation of unsold products. The refining segment's cost of goods sold as a percentage of revenue also suggests potential inventory buildup. Furthermore, lower throughput rates at refineries due to planned maintenance and the Martinez refinery fire resulted in temporary shutdowns, impacting supply chain operations. The Martinez refinery fire led to significant expenses, totaling $123.1 million, which negatively impacted income from operations. Additionally, the company's inventory adjustments and write-downs indicate potential issues with inventory management. The timing of inventory purchases also used a substantial amount of cash, highlighting concerns about inventory buildup and supply chain disruption. That concludes the financial summary for PBF Energy Inc. Feel free to comment below, and I will be happy to answer them when possible.